Good morning, friends. Just to introduce myself, I'm Amit Jain. Today we have a session on IND-AS 101, which deals with the first time adoption of IND-AS, right? That means this standard will only talks us about in respect of the certain exemption and the exception, and what are the different nuances on the at the time of IND-AS, at the time of adoption of IND-AS for the first time for a company. That means if a company is going for the IND-AS adoption in 31st March 2020 for the first time, that means the transition date is 1st April 2018, right? So what are the different transition options and what are the different principles which the company has to adopt as on 1st April 2018, which is the transition date, right? So this standard is applicable only for the first time adoption for a company, specifically for on the transition date only, right? So in this standard, we are going to discuss multiple things. For example, we will discuss about first time adopter, who is a first time adopter, first time adoption general principles, what are the different principles applicable for a company who is going to prepare for the IND-AS for the first time, presentation and disclosures, accounting policies, optional exemptions and mandatory exceptions. So there are certain optional exemptions and mandatory exceptions are given in the standard. So we need to discuss those optional exemptions and mandatory exception which are applicable to a first time adoption on the transition date, right guys? So with this small brief background, let's start the standard. First of all, guys, we need to understand who is a first time adopter. An entity that presents its first IND-AS financial statement, that is called a first time adopter. So for example, if there is a company who has adopted IND-AS as a mandatory adoption, right, in the year 1920, that means 31st March 2020, the company has to adopt IND-AS, company has to present their IND-AS financial statements, right, for the first time, then that company is called a first time adopter. So first time adopter is means a company or an entity that presents its first IND-AS financial statement as per the IND-AS principles is called first time adopter. Now the question arises, what do you mean by the first time IND-AS financial statement? First time IND-AS financial statement means when a company in its first IND-AS financial statement clearly mention that the company has adopted IND-AS by an explicit and the unreserved statement of compliance of IND-AS, then it is considered to be a first IND-AS financial statement, right? That means company has to mention that there is an explicit and the unreserved statement. That means there should not be any unreserved statement of the non-compliance. There should be a proper explicit and unreserved statement of the compliance of all IND-AS that needs to be mentioned in the first IND-AS financial statement. Then it will be considered to be a first IND-AS financial statement of the company. Previous gap, it is a very important definition. What is a previous gap? That means when we are adopting, when Indian companies are adopting IND-AS for the first time in India, what is the previous gap from which they have to transit to a new gap, which is IND-AS? So standard IND-AS 101 provides us the guidance. What do you mean by the previous gap? So previous gap means any basis of accounting used by the first time adopter used for the purpose of the statutory reporting requirement in India immediately before adopting IND-AS. So it means if any company has adopted any gap which is used for the purpose of the statutory reporting requirement in India before adopting IND-AS, that is considered to be a previous gap. Now apply this principle of previous gap practically. So in India, for the purpose of the statutory reporting, we have only one statute from the accounting perspective, which is MCA, right? Ministry of Corporate Affairs. So if any company is filing its accounts to MCA prior to adopting IND-AS, that accounts, that financial statement is considered to be a previous gap. And that previous gap shall be in accordance with Section 133 of Companies Act. Section 133 provides the guidance that or provides the or empowers the MCA to issue the standards in accordance or in consultation with ICI. So if any company is preparing its accounts or financial statement as per the requirement of the standards issued by Ministry of Corporate Affairs as per the powers empowered through Section 133, then that financial statement is considered to be a previous gap. So first a company has to determine which is a previous gap, who is a previous gap, and which financial statement is actually a previous gap, from which company is doing the transition from previous gap to new gap. So this is very important because it is absolutely required. What is the previous gap, whether it's Indian gap or it's any other gap? But from Indian gap is considered to be a previous gap, right? Next, we have the sum of the key requirement of IND-AS 101. So when a company is preparing its first IND-AS financial statement for 31st March 2020, right? So how many balance sheet which the company has to prepare, how many P&L which the company has to prepare, how many notes to accounts company has to prepare, how many period the company has to cover in its first IND-AS financial statement, that we need to discuss here. So if a company is adopting IND-AS for the first time in 1920, the company has to prepare opening balance sheet as on 1st April 2018. So that means company has to present the 3 balance sheet when the company presents its first IND-AS financial statement. So if I talk about the 3 balance sheet, it means the 3 balance sheet will be, first balance sheet is on 1st April 2018, which is the opening balance sheet. What do you mean by opening balance sheet? It means if the company would have adopted IND-AS from the inception of the business, how would the balances look like on the transition date as of 1st April 2018? That is the opening balance sheet. Then the company has to prepare its comparative balance sheet as of 31st March 2019. That means opening balance sheet as on 1st April 2018 will be carried forward, and then the company has to prepare 31st March 2019 comparative balance sheet, right? And finally, the company has to carry forward 31st March 19 balance sheet to the next year and prepare its final IND-AS balance sheet as of 31st March 2020. That means in the first IND-AS financial statement, company have to present 3 balance sheet, right? One is 1st April 2018, which is the opening, 31st March 2019, which is the comparative, and 31st March 2020, which is final balance sheet. Apart from this, the company has to prepare 2 profit and loss account, right? So someone may ask why we have 3 balance sheet and 2 P&L, right? The reason is very simple. The balance sheet is always prepared as a particular date, and P&L is to be prepared for a particular period and not for a particular day, right? Therefore, the period of P&L will be 2018 to 2019, and similarly 2019 to 2020. So that means there will be 3 balance sheet and 2 P&L in my first IND-AS financial statement. Similarly, we will have two period of cash flows. That means 1819 and 1920 will be my cash flows. After that, we will be having notes to accounts disclosure. So for the balance sheet perspective, for all the notes to accounts like PPE, like investment, like cash and bank, like trade receivable, and all the balance sheet items, we will be having three period numbers. That means 1st April 2018, which is the opening day, 31st March 19, and 31st March 2020. But from the P&L perspective, we will be having 2 year numbers. That means 1819 and 1920. So these are the basic requirements which a person should take care while preparing its first IND-AS financial statements. These are the different rules which a company should follow in respect of preparing its financial statement under IND-AS. So first rule is recognize all assets and liabilities which have been required by IND-AS. That means we have to recognize all those assets and liabilities which are required by IND-AS. That means it may possible that there are certain assets and liabilities which have not been required to be recognized as per previous gap, as per IND-AS, Indian gap. Now those have to be recognized. Example could be derivatives. Example could be embedded leases. So those needs to be recognized as per IND-AS, and these items are not required to be recognized as per previous gap under Indian gap. Second rule is de-recognize all assets and liabilities which have not been required by IND-AS. So I need to de-recognize, companies need to de-recognize those assets and liabilities which have not been required by IND-AS. For example, proposed dividend, right? So proposed dividend needs to be recognized, or it needs to be recognized in the year in which it has been declared, not for the year in which it pertains, right? Those needs to be de-recognized. So these are the different items which we need to identify, which has not been de-recognized, which have been de-recognized by IND-AS, and which have not been required to be de-recognized as per Indian GAAP. Third principle is reclassify all assets and liabilities as per IND-AS. Reclassify, that means we need to follow the IND-AS preparation, IND-AS financial statement, schedule 3, right? And we need to evaluate whether there is whether the transaction is an equity in nature or a liability in nature. Under Indian GAAP, we follow the form, legal form perspective, but under IND-AS, we follow substance over form. The example could be redeemable preference shares. That means if there is a redeemable preference shares under Indian GAAP, that is classified as equity. But under IND-AS, that redeemable preference shares shall be reclassified from equity to liability because there is a mandatory requirement or there is a mandatorily obligation to pay cash on the company, and therefore it will be classified as financial liability. Measures all assets and liabilities in accordance with IND-AS. The fourth principle is measurement. That means all assets and liabilities needs to be recognized as per IND-AS. That means IND-AS and IFRS are based on the principles of fair valuation. That means all assets and liabilities needs to be recognized at fair value only, unless those scenario where certain exemptions have been provided in IND-AS 101. Right? So if any transaction needs to be recognized while moving from Indian GAAP to IND-AS on the transition date, that transaction will be recognized through retained earning. That means the delta or the difference will be routed through retained earning. So these are the basic principles of IND-AS for the preparation of IND-AS financial statements. Next is accounting policies. So when a company is preparing its financial statement, that means when the company is preparing its financial statement for the 3 years, April 18, 1st April 18, 31st March 19, and 31st March 2020, the company has to ensure that the accounting policies must be consistent in all the 3 years. It cannot be possible that the company is using different accounting policies in opening date and comparative date, but different accounting policy in the final balance sheet date. That cannot be possible. So company has to use the same accounting policy across the 3 periods so that the period will remain the comparable. Right? So that's the very, very important aspect which every company has to take care of. Okay, guys, what else? Then we have the mandatory exception and optional exemption, right? Mandatory exception and optional exemption, very, very important aspect, because there are all the standards are applicable. Actually, all the standards, all the 38 accounting standards are applicable retrospectively, right? Retrospective means when the standard has come or when the transaction has come into the picture, the standard needs to be applied from that date. That means retrospectively. So these are the exemption which helps the company in order to avoid the retrospective application and apply the prospective measurement. That means if I have entered into a transaction in 2010, right, and my transition date is 1st April 2018, then what I need to do, I need to go back in 2010, account for the transaction as per the respective standard, and bring the carrying value as on the transition date and recorded. This is called retrospective application, right? So there may be certain kind of challenges which may arise because of this retrospective application, because all the standards are applicable retrospectively. Now here comes into the picture IND-AS 101. IND-AS 101 provides certain sort of relaxation, certain sort of exemptions to the company, that instead of going to the past, forget about the past, do the fair valuation on the transition date and move forward in your life. So guys, if you look at entire IND-AS 101, it is based on this premise: forget about the past, do the fair valuation on the transition date and move on in your life, right? So let's understand certain optional exemption. Optional means it is a choice has been given to the company whether to opt for that exemption or not. And mandatory exception is, it is a mandate which has been given, right, which the company has to adopt it without any choice, right? So let's understand what do you mean by optional exemption and what do you mean by mandatory exceptions. So there are certain exemptions, optional exemption have been provided in the standard. For example, PPE, property, plant and equipment, business combination, leases, cumulative translation differences, compound financial instrument, investments, decommissioning liability. So these are the key exemption or key optional exemption which we need to talk about. Okay, let's start with the PP exemption. So I give you a simple perspective. Let's say the transition date is 1st April 2018, right? So India 16 says that I need to go in the past from the date when I have actually acquired the PPE on a particular date, and I need to apply the principles of IND-AS 16 from that date and bring the carrying value on the transition date and record it. So that means if I have acquired 100 PPE, which is existing as of 1st April 2018, 100 line item, 100 assets, that means I need to go back in the past on their respective dates, right? And compute the number as per IND-AS 116, as per IND-AS 16 on that date, and bring the carrying value and bring the depreciated value as on 1st April 2018 and record it. So that means there are certain kind of challenges because it will involve lots of cost, lots of efforts in doing the retrospective application of IND-AS 16, right? So now in order to provide a relief to the companies, IND-AS 101 comes into the picture, and IND-AS 101 says that instead of going in the past, do the fair valuation on the transition date and record it and move on in your life. That means forget about the past, record the fair valuation on transition date and move on in your life. That is what the exemption have been given in IND-AS 16 in respect of the fair valuation. This is the same exemption which has also been given under IFRS, under in IAS 16, under the IFRS standards, right? But in India, what we have done additionally, we have given one more carve out. We have given one more additional exemption to the companies that that instead of having a fair valuation, the company can also do the carrying value exemption. The company can also adopt the carrying value exemption as of 1st April 2018. That means as on the transition date. That means the company has an option under IND-AS either to go for the fair valuation on the transition date or to go for the carrying value exemption on the transition date, right? So carrying value exemption, what is the meaning of carrying value exemption? Carrying value exemption means whatever the number was appearing as of 31st March 2018 as per the signed and audited financial statement, that numbers will become the opening numbers as on 1st April 2018, which is a transition date in our example, right? Now the question is, what is the carrying value? What is the carrying value? Carrying value means the gross value minus accumulated depreciation minus impairment loss is called a net carrying value. So that net carrying value as on 31st March 2018 will become opening gross block as of 1st April 2018 on transition date. That means whatever the accumulated depreciation is and whatever the impairment losses that has gone, that has been buried. So in the past, ICA has issued certain FAQs, and where the ICA has said that where the company has taken the carrying value exemption, the company has to recognize the net block as of 31st March 18 as on 31st March 18, which was appearing in the audited financial statement. That net block will become the gross block as on 1st April 2018. That means on the transition date. That means accumulated depreciation will be nil, impairment loss will be nil as on 1st April 2018. That means on the transition date. It also results into one more aspect. That means the impairment loss which has already been gone in the past, in that net carrying value, that cannot be reversed in the future. That means it is very important for the companies who have the impairment loss in the past. If they are going for the carrying value exemption, they should be aware of this provision that if they adopt the carrying value exemption on the transition date, the impairment loss provided in the past cannot be reversed in the future, right? So these are the different nuances which the company should take care of in order to adopt the carrying value exemption, right? Couple of more aspects we need to look at in respect of the carrying value exemption, the fair value exemption. Selective PPE, right? In case of fair value exemption, it is not allowed. Sorry, in case of the fair value, it is allowed, and in case of the carrying value, it is not allowed. That means if there is 100 items, 100 line items in the fixed asset register, the company can go for the fair valuation of any of the line item or any of the assets appearing in the fixed asset register. That means if there are 100 items appearing in the fixed asset register, company can go for the fair valuation of the 10 items, and for the balance item, company have to go or apply IND-AS 16 principles, which is a retrospective application. But carrying value, no cherry picking is allowed in this case. Company has to adopt the carrying value for the all class of fixed assets. right? No cherry picking is allowed in case of carrying value exemptions. Processing cost. If there is any processing cost, then that shall not be adjusted if the company has taken fair valuation route. But if the company has taken the carrying value exemption, then that processing cost shall be adjusted in the carrying value in order to ensure the compliance of the other standards. Decommissioning liability. Decommissioning liability shall not be adjusted if the company will take fair value exemption. But if the company will take carrying value exemption, that decommissioning liability shall be adjusted in the cost of PPE. Government grant, no adjustment shall be allowed in case company is going for the fair value exemption. But if the company is going for the carrying value exemption, that government grant adjustment shall be made, right? So these are the different aspects which a company has to take care while going for the fair valuation exemption or carrying value exemption, right, guys? So this is about the PP exemption. Now let's talk about the business combination exemption. First of all, we need to understand what is a business combination, right? So business combination means it is actually defined under IND-AS 103, which is a standard which talks about the business, which is a standard which talks about the detailed accounting treatment in case of the combination of business, right? So that standard says what is a business. A business is basically a activity which involves input, which involves processing of the input, and which is capable of generating the output. That is called a business. So any entities having an input, processing of those output, which are capable of generating the output is called business, right? So if there is an acquisition, in that is called a business combination as per IND-AS 103, right? So what IND-AS 103 says, in IND-AS 103 says that if you have done a business combination in the past, right? So what we need to do, we need to recognize all the assets and liabilities existing as on 1st April 2000, existing as on 1st April 2018 at fair value only. That means I need to go back in the past, compute the transaction accounting, compute the fair value on the transaction date, and bring the carrying value on the transition date and record it. I need to compute the goodwill as well, right? I need to compute the goodwill as well. So it's a challenging task for the entity who has done a lots of combination in the past, who has done lots of business combination in the past, right? So company has to go back in the past as per IND-AS 103, bring the carrying value, compute the carrying value, and bring the carrying value as on the transition date and record it. It involves a lot of cost, it involves a lot of time, it involves a lot of efforts. So in order to avoid all the scenario, IND-AS 101 comes into the picture and provides certain guidance. What IND-AS 101 says? IND-AS 101 says that there are three options which have been given to the management, and it is a choice to the management to opt for any of those exemption. So first exemption IND-AS 103 says, IND-AS 101 says that do not restate any business combination done by the company in the past, right? So I'm repeating again, do not restate any business combination done by the company in the past. That means prior to transition date, there is no need to apply IND-AS 103 retrospectively. This is the first exemption within the business combination. Second is restate all the business combination. That means all the combination which the company has done prior to transition date, company is required to apply IND-AS 103 retrospectively in that scenario where the company goes for or opt for restating all the business combination. The third scenario is restate from a particular date. So for example, if I am doing the transition, if I'm having a transition date of IND-AS is 1st April 2018, and if I adopt 1st April 2015 as a date on which I will do all the combination, all the business combination at fair value, that means prior to 1st April 2015, I will not apply IND-AS 103. But all the combination which has happened on or after 1st April 2015, I will apply IND-AS 103 retrospectively for those combinations. So that means the choice has been given to the management to select a date, right? So it may be the objective of this that it may possible the management wants to restate from a particular date, right? Because the management have the information for only those restatement, only for those business combination, but not prior to that particular date. That is why the choice has been given to the management. right? So that is what the business combination exemption is. So if I need to summarize, what is the business combination exemption? Very simple. First, restate all the business combination prior to transition date. Second, do not restate any business combination existed prior to transition date, and restate from a particular date which is given by the management. So this is what the business combination exemption is. Then we have the lease exemption, right? Lease exemption, lease, we all know that the new standard has come up in India, which is effective from 1st April 2019 in India. And this standard has changed the accounting in the books of lessee in respect of the operating lease. Right now, we need to capitalize operating lease in my books of accounts as a part of the ROU asset with a corresponding liability as a financial liability or the financial lease liability. Right, so let's understand what is the transition exemption has been given to in respect of IND-AS 116. So please remember that this exemption is only available to a first time adopter to IND-AS. This exemption is not applicable to those companies who have already adopted IND-AS in the past, right? So people may ask, then which transition option should I apply if I have already adopted IND-AS in the past? So in that case, company has to follow IND-AS 116 only, because IND-AS 116 provides couple of types of transition exemption. One is the full retrospective and second one is the modified retrospective approach. Right, so company has to follow IND-AS 116, which are already adopted IND-AS in the past. So but for the companies who is going to adopt IND-AS for the first time, who is going to adopt IND-AS for the first time in March 2020, then what should be the IND-AS 116 transition policies, that is, or exemption that is given under IND-AS 101. So first point is how to compute the lease liability. So IND-AS 101 says that the company has to compute the lease liability prospectively. That means as on 1st April 2018, in our example, company has to compute the fair value of the future lease payment. Present value of the future lease payment, that will be my lease liability. That will be the present value will be the lease liability of the company. And how to compute ROU? The company has an option either to compute the ROU retrospectively or amount equal to the lease liability. That means whatever amount the company has got as a lease liability, that will be assigned as a ROU. That is the first option. Or the company can apply IND-AS, and the company can apply IND-AS 116 retrospectively in order to compute the ROU asset. Right, so this is the way the company should account for IND-AS 116 on the transition date. Right, these are the optional exemption. That means it is a choice given to the company whether to adopt these exemption or not to adopt. In case the company do not adopt these exemption, then the company has to go back to IND-AS 116 and apply its transition date accounting principles. Now the question arises, if the company has recognized the ROU, whether it is subject to the impairment provision of IND-AS 36? Answer is yes. This ROU, which is to be recognized as per IND-AS 116, that is subject to IND-AS 36 impairment provisions. Right, guys? So these are the different aspects in respect of the first time adopter for in respect of the first time adopter in respect of the optional exemption on the transition date. Now we have IND-AS 101 versus IND-AS 116 principles. So for a first time adopter, the question is that whether a first time adopter adopts a modified approach. Answer is no. The first time adopter cannot adopt the modified approach. The reason is first time adopter, if adopts modified approach, that means that approach is applicable only from 1st April 2019. Right? So when the first time adopter is preparing 31st March 2020 accounts, accounting policies must be consistent. That is what we have just read 15 minutes ago. So if the first time adopter adopts modified approach, this will result into an inconsistency accounting policy, right? Because till 31st March 2019, the adopter or first time adopter represent that he has adopted IND-AS 17, right? However, IND-AS 116 will get effective in that particular day, in particular scenario from 1st April 2019 if he would have adopted modified approach. So this resulted into the contradiction of IND-AS 101 versus IND-AS 116. So therefore, modified approach is not allowed in case of first time adopter. So the question arises, then a first time adopter, how the first time adopter should adopt or apply the provisions of IND-AS 116. So there are two options. One is the first time adopter applies IND-AS 101 exemption, right, on the transition date, or he can adopt full retrospective approach, which is given under IND-AS 116, in which the comparative has to be restated, in which all the financial years, that means all the comparative financial year, he has to apply IND-AS 116 retrospectively. So two options, one is IND-AS 101 and second is retrospective application of IND-AS 116. So that means modified approach is not applicable in case of first time adopter. Right guys, then we have the how should we account for the lease equalization reserve, which is appearing as on the transition date. So if the first time adopter has adopted the full retrospective approach, that LER, which is the lease equalization reserve, that will get adjusted through the retained earning, right? Then if the adopter has adopted the modified retrospective approach, right? So this is not only in respect of the first time adopter, this is also in respect of any company who has already adopted IND-AS, right? So the company, if the company has adopted the 2A approach of modified, what is the 2A approach? Where the ROU is to be applied retrospectively and liability is to be applied prospectively. In that case, lease equalization reserve shall be adjusted with retained earning. But in case of 2B modified approach, 2B means where ROU is equal to lease liability and both are needs to be computed prospectively, then it will be adjusted against the ROU asset. So these are the different aspects which the company should take care while doing the accounting of the lease equalization reserve on the transition date. Next exemption, we have the cumulative translation difference. What is the cumulative translation difference? So cumulative translation difference is nothing but a foreign currency translation reserve, which will arise only at the time of doing the consolidation, right? So let's say I'm a holding company which is located in India, and I have a subsidiary company which is located in US. While doing the consolidation, I need to convert my subsidiary into INR currency. And by doing that conversion exercise, I have a delta in my balance sheet. That delta is called cumulative translation difference account or foreign currency translation reserve account, right? So the exemption has been given. The company can transfer whatever the balance lies in the cumulative translation difference to retain earning. That means company can set the CTA, cumulative translation difference account, to zero. Company can set this account to zero and transfer all the numbers to retain earning, right? So that cumulative translation difference will be the once the company is starting their books from IND-AS, company will maintain the entire balances and company can maintain and record and company can have the proper ledger accounts in respect of what is happening in the cumulative translation difference account. So option has been given that the company can put or assign these numbers to zero and transfer all the numbers to retain earning. Compound financial instrument. So I hope we all know the compound financial instrument, the mixture of financial liability and equity from the perspective of the issuer in a same transaction is called compound financial instrument. So it simply says, as per IND-AS 32, we need to adopt a split accounting. That means I need to bifurcate the financial liability. I need to bifurcate the equity, right? So this standard says if the liability has been paid, if the liability has got over prior to the transition date, right, then there is no need to do the split accounting. Then there is no need to apply IND-AS 32. That is what the exemption is given by IND-AS 101. Right? Then we have the next exemption on account of investment. Investment in the subsidiaries, JV and associates. We need to be very careful that this exemption is only applicable in case of subsidiary, in case of joint venture and in case of associates. Right? What is that exemption? The exemption is only applicable on the transition date, and that exemption is basically the company can do the fair valuation on the transition date or company can adopt the cost approach on the transition date, right? So if the company goes the fair valuation on the transition date, the company can treat that fair valuation on transition date as a deemed cost and will carry its investment at the deemed cost in the future. Or the company can go for the cost on the transition date. So that is the exemption which is given in respect of the investment in subsidiary, JV, and associates. Right? I have seen multiple cases where the subsidiary has made a cross investment in the holding company in respect of that transaction. In respect of that transaction, guys, the exemption is not available. It is only one-sided from holding to subsidiary to JV and to associates. Vice versa is not allowed. Decommissioning liability. So IND-AS 101 says that a first-time adopter has to fair value its decommissioning liability in accordance with IND-AS 37 on the transition date and record it. Right? So that is what the exemption is given, that instead of going in the past and do the retrospective restatement and instead of doing the retrospective application of that IND-AS 37, the first-time adopter can do the fair valuation on the transition date and move on its life. So these are the different exemptions. So I've talked about only the key exemption or key optional exemption of IND-AS 101. Then we have the mandatory exceptions. So there are certain mandatory exception has also been given in the standard, right? For example, retrospective application prohibited for the use of estimates, right? That means I cannot change my estimates in the past. Why I'm saying past? So for example, if I'm preparing my accounts for 31st March 2020, so that means 31st March 18 and 31st March 19, I have already signed my Indian GAAP accounts and filed it to the ROC and MCA, right? So if I'm changing my accounts from Indian GAAP to IND-AS as on 1st April 2018 and as on 31st March 2019, I cannot change my estimates, right? Existing as on those particular dates unless and until those estimates are in errors, right? Hedge accounting. I can adopt the hedge accounting only if the hedge was effective in the previous gap as of 31st March 2018, right? Only then I can adopt the hedge accounting on the transition date. Then certain mandatory retrospective certain exemption have been given for the retrospective application. Certain exemption in respect to the retrospective application, for example, de-recognition of financial assets and liabilities, some aspects of accounting of NCI, which is a non-controlling interest, classification and measurement of financial assets, impairment of financial assets, embedded derivative, government loans. So these are the items where the company do not have any option to apply the retrospective application. The company has to apply IND-AS 101 principle, which says instead of going in the past, the company has to do the fair valuation on the transition date, record it, and move on its life. So these are the mandatory exception which the company has to adopt. Thank you very much, guys. Thank you very much.